But maybe Freeman knows somebody else. Billy Freeman wasn't suggesting.
Yeah, get closer. Yeah, I didn't see that.
That is.
I didn't get to that point. The lady was here. That's not done.
Fonda, we were waiting. Craig's just trying to give you a hard time.
All right, it is 10:30, and I welcome you all to the September 8th meeting of the Oklahoma City Post-Employment Benefits Trust. And the first item that we have on the agenda is to approve the minutes from the July 14th meeting. Move them.
Second.
All in favor?
Aye.
Any opposed? Great. Next item is there's actually receiving the investment reports for July 31st and August 31st. And then the next item after that will be presentation of the second quarter 2014 investment report as of June 30th, 2014. And Tony Kay is here with Gregory W. Group. I'll let him cover all of that, and then we'll come back and receive the report.
Great. Thank you, Craig. For those that I have not had the pleasure of meeting, my name is Tony Kay. I'm with the Gregory W. Group. I'm Executive Vice President with the firm, and I've been there for just over 10 years. I work closely alongside with Doug Anderson and Greg Weaver, who I believe you guys met 2 quarters ago, so you're getting to see the full rotation now. Doug does send his regards. But we'll move into the quarterly report, starting with the economic review. Some of this data is somewhat outdated, so I'll be brief on this, but please stop me if there are any questions or if there are any data points that you would like me to go into further. But it's been a pretty nice market for equities in particular. Fixed income's held its own. Interestingly enough, we've had, given kind of the low growth environment that we've been in, employment has actually ticked down quite a bit. As of the writing of this report, the unemployment rate had improved from 6.7 to 6.1% at the end of the quarter. It's kind of a mixed bag, though. As you look at the labor force participation rate, it's dropped off somewhat, which has helped that figure improve, the unemployment rate figure improve. Unfortunately, a lot of the jobs that have been added have not been the high-income jobs that we really need to kind of move the economy forward. But there are some positives out of the labor market. Employment figures are coming in nicely. Firms are starting to hire, but they are having trouble finding the skilled laborers that they're looking for. Looking at GDP growth on the bottom right-hand side of the page, pretty interesting picture here. You can see that pretty dramatic dip in the first quarter of 2011. Recall all the winter weather issues that we were having. That really weighed on economic performance during the quarter, but rebounded nicely for the second quarter of 2014 with a positive return of 4%. So GDP is coming in strong for the quarter, but it doesn't look like that rate's going to be high enough to get us to the 3% that many economists were predicting earlier in the year. Moving on to the equity markets, on page 2 of the quarterly report. Again, really good, strong performance for the quarter. The Russell 1000, this is the 1,000 largest U.S. companies, was up 5.1% for the quarter. The trailing year return moved up to 25%, so very strong results out of that market. You can see where the sector breakdowns are on the bottom right-hand side of the page. It's pretty interesting when you look at which sectors helped provide that 5% return for the quarter. Energy at 10.5%, information technology at 10.6%, and then most surprisingly is utilities at 7.9%. not exactly the three sectors that you would expect to add to that performance, just kind of a diversified set. Usually those sectors don't move in tandem with one another, but some interesting dynamics in the markets going on right now. One of the questions we typically get is, where, equities have had a nice run, where are they going looking forward? And we think there's still a lot of value in equities. The top right-hand side of the page, if you look at equity valuations, several parts of the market look very reasonable, especially on a valuation standpoint. You can see large blend growth, mid-cap growth and small-cap growth are all below their long-term average based on a valuation standpoint. And when you factor in the low returns in fixed income, there's just not a lot of people that are looking to leave the equity market. So we talked to equity managers. They've obviously been excited about the returns that they've enjoyed, but the outlook is, I think, a little bit better than most of us tend to expect when we turn on the news. Fixed income on page 3. This has kind of been a surprising area, I think. If you would have asked most investors a year ago where interest rates would have been at the end of June 30th, 2014, I think most people would have said quite a bit higher. In fact, the opposite happened. You've had the Fed continue with quantitative easing. Even as they've taken some of that off the table, rates have gone down. I think we find some comfort when you compare the U.S. Treasury rates to non-U.S. rates, specifically mainland Europe and Japan. When you compare 10-year Treasury rates to Japanese bonds or European bonds, 10-year Treasuries for the U.S. actually have close to a 1% yield advantage. You look at Italian spreads and Spanish spreads over the 10-year Treasury, and those are in the 10 to 20 basis point range. I don't know about everybody else, but I think I'm a lot more comfortable investing in 10-year Treasury bonds than I am Italian and Spanish bonds at those rates. So have some nice demand going forward from that standpoint that we think will, won't result in higher interest rates in the near term. That's what we're hearing out of the Fed as well. Alternative investments are on the following page. I won't spend a lot of time since the Opebt Trust does not have any assets allocated to that area of the market. But moving on to the box score on page 5, you can see just how strong returns have been. It's really been across the board. Show domestic equity on that top table, everything close to 25% returns. S&P 500 was up just under 25% for the year. The trailing 3 years on an annualized basis up 16.6%. And then over the last 5 years up 18.8%. When you take that annualized compounded rate of return and turn that into a cumulative figure, that's better than a 100% return, just showing it's how strong the markets have been. It helps that we've dropped off that 2008, 2007 time period when markets got really challenged during the financial crisis. Fixed income, good returns out of that sector. Pretty interesting if you scroll down to third to the last row, the Merrill Lynch U.S. High Yield Master 2 Index. Those are junk bonds, below investment grade U.S. bonds, showing just how much investors have been looking for yield. That area of the market returned close to 11.8% for the last year, and that's a new allocation that this portfolio has just after June 30th, so like that exposure. On the international side, performance hasn't been as strong as we've enjoyed in the U.S. You can see the MSCI EAFE, that's the developed only markets, was up 24%, but if you go to the last 3 years, trailed the S&P 500 by more than half, last 5 years trailing as well. Emerging markets have been another story as well. Recall 3 years ago that was the place to be, kind of the most sexy place to be, if you will. But you've had Brazil and China slow down. Last 3 years, annualized rate of return is negative 2.9%. So a lot of dollars have come out of that sector and come into the U.S. That's all I have for the economic review. If there aren't any questions, I'll get into the portfolio return. Great. Page 6. Trailing 1 year return as of June 30th, 15.2% net of fees, better than 3 times the actuarial assumption rate. So we're really pleased with that figure. Strong returns pretty much across the board, all portfolios contributing nicely. So good participation in the equity rally. Moving on to page 7 is a performance summary, just where those returns were generated. You can see the last quarter, composite was up 3.5%, and then over the last year, as I mentioned, up 15.2%, domestic equity up 17.2%, and international up 21.8%, helping drive that nice outperformance versus the actuarial assumption. And then over the last 3 years, the composite's up 7.4%, outperforming the actuarial assumption rate as well. Page 8 just shows a breakdown of quarterly results, ended June 30th. I'll leave that for your own reading. And then annual history return is on page 9. Excluding 2011, which was a very tough time period for active managers, the portfolio has performed nicely versus its actuarial assumption. In fact, it's outperformed the actuarial assumption rate by a wide margin over all those observation periods. And then for 2014, year-to-date, off to a good start as well. The fund was up 3.5% versus the actuarial assumption rate of 2.4%. So making good gains year-to-date, setting us up nicely for the rest of the calendar year versus the actuarial assumption rate. Start to get into the breakdown of the quarterly return on page 10, just what drove that performance for the quarter. You can see the bond fund helping somewhat, but a lot of the performance was driven by the large cap equity manager, that's Dreyfus Appreciation, accounting for 2.4% of the quarterly return. Stevens Small Cap was the only manager to register a negative return. They had a little bit of a difficult time period, but thankfully they're a smaller part of the portfolio, so the impact of that portfolio is somewhat muted on the overall portfolio. More on them later. Discussion items on page 11. Good results for the quarter. In early 2012, there was a transition from a single equity manager to 3 equity managers, those being Dreyfus, Delafield, and Stevens. So the board has kind of opened up the capitalization structure. And in our view, there's more sources of alpha going forward, which we think was a good move. Causeway replaced Thornburg during the first quarter of 2014. That was a very positive move. Since the writing of this report, there have been some more personnel departures at Thornburg, so we're having conversations with our other clients that are still invested in Thornburg and moving more assets away from them, so that the timing of that was very good. And then new fixed income structure is nearly complete. We've replaced J.P. Morgan with 2 fixed income managers on the core side, a high yield manager, which has done nicely, and then an active duration portfolio. Those results are in your July and August updates. Asset allocation history on page 12. You can see started the portfolio, the very cautious, prudent portfolio structure at the inception of the funding. Since that time, there have been additional allocations to equity, as well as a nice run-up in the equity markets. So if you look at, as of quarter end, there was just under $18.2 million allocated to equities, domestic equities, just under $3 million to international equities, and just under $9 million, bringing the total portfolio's value as of June 30th to just shy of $30 million. So very, very nice, diversified view in our opinion. Moving on to the individual managers, starting on page 13, the first manager is J.P. Morgan. I won't spend a lot of time since subsequent to this report they were replaced, but J.P. Morgan did a fine job. If you look over the last 3 years, matched the performance of the benchmark net of fees. It was always going to be difficult for them to outperform by that much, just because they're a core bond portfolio manager, meaning that they don't have a lot of the exposures to high yield and the spread products that some of their peers are able to invest in. But solid portfolio, 1/3 of the assets as of quarter end. Moving into equity on page 14, Dreyfus Appreciation, interesting group, large cap portfolio, really good performance for the last quarter. Net of fees return was 6.5%, outperforming the benchmark by over 1% and beating 97% of their peers. they have an interesting take. They tend to invest in franchise household names, which we like when markets get a little bit more challenging. We think those names tend to hold up a little bit better. Consumer defensive, you can see, was 29% of the portfolio. As of quarter end, and when markets get a little choppy, that's kind of the area that really holds its own. PE ratio of 16.2 versus 22.1 for the Russell 1000 growth. So even though they're a large cap growth manager, they do have a disciplined approach to the values that they'll pay for the companies that they invest in. Turnover ratio here is quite low as well. They're not churning the portfolio. They're not traders. They're in it for the long haul. You can see as of quarter end, the turnover ratio is 6%. So on average, they're holding the companies that they invest in for close to 18 years. So they really do get to know the names of the companies that they invest in. One other thing that's worth noting on this page is the allocation. Non-U.S. stocks at 16.2% as of quarter end. By mandate, they're allowed to invest up to 20% of the portfolio in non-U.S. stocks. Mainland Europe, as I referenced earlier in the report, just hasn't generated the performance that the U.S. equities have. But they think that there's a lot of value across the Atlantic. So that makes sense when you think about their approach to investing. They want to go where names maybe aren't as hot or as popular and wait for those valuations to come up. So I think that's a nice facet to this portfolio. Delafield on page 15, starting to move down the capitalization structure. This is a mid-cap value portfolio. Really good performance for the last 12 months in absolute returns, up 24.4%. Trailed the benchmark slightly, but when you start to look at their sector weightings, that becomes evident why. Close to 22% of the portfolios was in materials. That's an area of the market that they've navigated for some time and know quite well, but unfortunately that was the worst performing sector to be in for the last year. If you look at their allocation, close to 14% of the portfolio was invested in cash. If you talk to Dennis Delafield and Vince Selecchia, the two portfolio managers at Delafield, it's interesting. They're not as excited about equity valuations as some of the other managers that we talk to. They think that valuations have gotten a little stretched, especially where they invest. So they're keeping some dry powder. They've done that historically and have done a good job of allocating cash to underperforming stocks at the right time. So it's tough to look at them when the market's up 26, 27%, when they've got close to 15% in cash. But when you take a holistic view of the portfolio and think about where it might be 3 years from now, we like how they're investing. $3.6 million as of quarter end, 12% of the plan's assets. Stevens, another newer manager to the portfolio, similar story. Stevens is based in Houston, Texas. We had a meeting with them just about 3 weeks ago. They had a little bit of a tough quarter. Most of that was due to their technology holdings at 25%. But they don't invest in kind of the more exotic names, the high growth names, the higher beta, higher volatility names. And that's really where the market's been. I think the quantitative easing that's out there and the loose monetary supply has really elevated a lot of names, especially in the small cap space, that probably wouldn't warrant consideration if that easy money wasn't out there. So they have had some detraction of performance due to the investing environment, but they have a great track record long term. We think the portfolio is well suited for the market going forward. Causeway on page 17 is the international equity manager. Looking at their performance over the last 3 years and 5 years, they've been one of the top managers. Harry Hartford and Sarah Ketterer are the two managers that oversee this portfolio. Really nice industry knowledge, a deep bench that helps them screen for countries across the international equity investing markets. They don't do a lot in the emerging markets. That's been to their benefit, especially over the last 3 years. You can see as of quarter end how the portfolio is allocated, close to 23% to the United Kingdom, so they're finding a lot of value in that space. Switzerland at 14% and then France at 13%. A little bit of a challenging quarter for them. A lot of that was due to their financials holdings. UBS was that was their top third holding in the portfolio. Had a little bit of a struggle due to some settlements with the Department of Justice, but they think that's behind them now and expect good things going forward. P/E ratio of 13.8 for this portfolio versus 16.1 for the MSCI EFA, so you can tell that they have a price-conscious approach to investing, which pays dividends for them. Speaking of dividends, the yield on this portfolio as of quarter end was close to 3%. So not only do you get nice participation from capital gains, but there's a nice dividend kicker in there as well. Moving on to the total portfolio on page 18, you can see well-diversified portfolio. Total plan for the 3 months ended June 30th was up 3.5%. For the 1 year was up 15.2%. And then for the last 3 years, annualized basis was up 7.4%. I think it's a very prudent, sound portfolio structure, diversified. I think there's a lot of embedded value in the portfolio. When you talk to the managers, they all tend to have a little bit of a different view going forward on where equity performance will be, and we like that. We don't want all of our managers to think exactly the same way about the markets. If they do, then you're probably not diversified. So good performance, trailing the policy index and the allocation index, but most of that's due to more defensive portfolio. And we're very comfortable with that, especially when you consider what might lie ahead of us. Breaking the portfolio review down on page 19, showing the market value history over time, steady contributions in the table on the right-hand side, and good performance out of the equities has led to a nice upward progression. Allocation by asset classes on page 20. The risk-return scatter chart is pretty interesting. Most of those portfolios land above the line, Causeway International being the outlier there. But we would expect some reversion to the mean as more investors start to look at non-U.S. stocks and invest in those markets. We would think that returns going forward there will be quite nice. Actual versus target allocation on page 21. No major things to point out here. The portfolio is within compliance and close to target asset allocation in all asset categories. Moving on, domestic equity portfolio statistics. You can see the alpha on this portfolio. It's a measure of risk-adjusted performance. You always want to see a positive figure there. 0.42 for the last 10 years. That's a good figure in our eyes, meaning that you are being paid to invest in active managers. Mean annual return over the last 5 years, this portfolio, just the domestic equity portfolio, was 18.05 net of fees, so close to the S&P 500 and close on a risk standpoint when you look at standard deviation. Cumulative performance history on page 23. I don't have remarks for that. I think that chart speaks for itself. And then the manager status summary on page 24. JP Morgan Bond Fund was terminated as of quarter end. Those assets have been moved to the new fixed income managers. There's been one issue getting one of those managers funded, but we're working with Bob and staff to get that taken care of and expect to have that turned around quite soon. Dreyfus Appreciation is the only manager that's on alert. They had a very good quarter, but we think given the fact that they're 1 year still below the benchmark that it makes sense to keep a close eye on them and keep them on alert, but do want to note that they had a nice recovery during the quarter and ranked in the top decile of their peer universe. No other changes are recommended for any of the other managers. They're performing as we would expect. Monthly return correlations on page 25, just giving us a good picture of how diversified these managers are one to another. We tend to look for managers that have a correlation of 95 or lower, and I don't see a single figure on this page. It's even in the 90s. So from a statistical standpoint, a very nice portfolio structure. There's not a lot of overlap between them amongst the managers. And then the final page of the report is the expense comparison on page 26. We've done a pretty good job in negotiating fees with managers, making sure to hire managers that are building quality portfolios at a reasonable price, and every single manager that's in the portfolio is below category average, representing a fee savings of better than 25 basis points on an annual basis. So a very good figure. That's all I have for the quarterly. Happy to take any questions about the portfolio, any of the managers, or any other issues that the board sees.
I have a question, Mr. Chair. Are both of the reports that you provided us through June 30 of 2014?
This quarterly is through June 30, and then I believe you have 2 monthly reports that are through July 31st.
We also have a
August.
July and August report.
Okay, so I wanted to make sure, because I'm looking at the percentages and they vary quite a bit. I wanted to make sure that the time period we were looking at, they were different. Now, my question on the monthly report, it's updated as of August 31st of 2014. My question is concerning the index that we're comparing, particularly Dreyfus to. It shows the S&P 500, and I think on on this other report, we're comparing it to the Russell 1000. Particularly if you look, let me get to that page.
So you're comparing that to the quarterly report, Diana?
Yes. If you look on page 14 on the Dreyfus Appreciation Fund, we're comparing that to the Russell 1000, but on the monthly report, we're comparing it to the S&P 500. Now, I do notice on the summary, you're comparing it to both of those indexes. Can we, if we're going to use both of those indexes, can we get those also reflected on the monthly report?
Absolutely.
I think it's a little misleading. Okay, thank you.
Are there any other questions? Okay, you want to touch on the monthly reports?
Yeah, sure. Why don't we just flip to the August monthly report, since that's the newest data, and July was a negative month.
2 very good reasons.
So August 13, I'm on page 3 of the monthly report. It's really a pretty good month for all of the managers. You can see the new fixed income managers were funded with the exception of the Loomis Sales High Income Fund. Both of the Core Plus managers, the Loomis Sales Bond Fund and Double Line Bond Fund, matched their benchmarks. So that was good for close to top quartile peer universe ranks over the last 3 months, ranking in the 5th percentile. Hoisington is the active duration bond manager. Recall that all they do is forecast interest rates and their outlook for interest rates. They're very long-term focused, and the portfolio is invested in very long-dated U.S. Treasuries, and that was to their benefit for the month. They were up 5.2% as interest rates on long-term Treasuries came down for the month. We like that portfolio because you get that higher yields on the long-term Treasuries, but then this portfolio moves nicely when equities tend to sell off. You can see it's typically a perfectly positive negative correlation. Perfectly negative correlation to equity market moves. So you get a nice, some nice downside protection from them. Delafield came back somewhat during the month, still trailing for the quarter. And then Stevens, their portfolio turned around nicely, up 6.2% for the quarter. You can see the total fund was up 2.6% for the month, 1.9% for the last 3 months, and then 12.8% for the last year. The portfolio itself is now above $30 million, so nice gains leading to that higher market value. I think that's all I have on the August monthly update. Any questions?
Are there any questions?
Well, probably just a comment. I do notice that we have, you mentioned we have some downside protection when the market is down, but I noticed that we've been trailing the policy and the allocation index. Is there anything we can do to try to close that gap a little bit?
Yeah, I think some of the new portfolios that have been added in fixed income will really help. JP Morgan was doing a fine job, but just the way that they approached the bond bond investing, the areas that they were capable of investing in, they just couldn't expect a lot of outperformance from them. So we like those changes. We would expect that to add nicely to performance going forward, especially versus the allocation and policy benchmark. We also think that, where equities stand right now, it's pretty much you could have thrown a dart at the board and been fine in equity investing. Everything that we're hearing from all the managers that we talk to is that, the easy money's been made. It's time for the guys and gals that really roll up their sleeves and do their due diligence and their homework to start performing. We think that there's going to be dispersions in equity results going forward, and we think the active managers here will be able to capitalize on that. So we'd expect that going forward.
All right, any other questions? Thank you, Tony.
Thank you.
Move to receive the reports.
Second.
All in favor? Aye. Any opposed? Next item we have is the quarterly financial statements for June 30, 2014. Mitchell, are you going to make a presentation on that? Okay. Mitchell Massey with the Accounting Services Division in the Finance Department.
Good morning, everyone. First, I would like to direct your attention to page 3, the Management Discussion and Analysis, Changes in Net Position Reconciliation. Currently, the Trust is reporting net position of $34.03 million. This is an increase of $7.7 million over the prior year, when the net position was $26.32 million. Overall, the financial position has improved during the year. For the fiscal year, the Trust gained approximately $7.7 million. Of this, $3.3 million is from investment income, while $5.4 million is from excess employer contributions, offset by a loss on net assessed revenue of $970,000. Next, I would like to direct your attention to page 6, Statement of Changes in Planned Net Position Reconciliation. Additions are reporting at $32.9 million versus $31.6 million in the prior year. This is mostly due to investment income increases for appreciation and fair value of investments as contributions remain stable. Benefits were $25.2 million, which was an increase of $797,000 as a result of the indemnity plan expenses increasing from the previous year, offset by a decrease in HMO. Now I would like to direct your attention to page 10, the Asset Allocation Guidelines. In our asset allocation guidelines, fixed income securities are reporting at 29.9%, leaving the remaining to equities at 70.1%. Now, if you look above on page 9, the money markets used to pay claims are reporting at $5 million compared to the prior year of $4.7 million. Are there any questions I can answer regarding these financial statements?
Anyone have any questions? All right, thank you, Mitchell.
Thank you.
Can I get a motion on the interim financial statements?
Move it.
Second.
All in favor?
Aye.
Any opposed? Next item we have is to ratify the claims listing. Can I get a motion?
Move it.
Second.
All in favor?
Aye.
Any opposed? Great. Are there any other comments or any other information from staff or from the board? Seeing none, we are adjourned.